Where are we right now in deal flow?
Well, we're actually in a period of returning activity. So if you look particularly in the U.S., announced transactions in the first 5 months of the year are about 40% of last year. The last 2 years have been a period of low activity, driven predominantly by uncertainty rather than economic uncertainty, because that is the enemy of M&A activity. And if you look back over the last 45 years, go back to 1980, M&A has generally been characterized by 5 to 8 year up cycles and 2 to 3 year down cycles. And we're kind of at the end of that 2 to 3 year down cycle and at the beginning of what I suspect will be an extended period of increased activity, 24 being better than 23 and 25 being better than 24.
So as you know, here at Bloomberg, we pay a lot of attention to the Fed. Are they going to cut it? They're not going to cut it. They're going to raise. What's going to happen? At the beginning of the year, there was something like 6 rate cuts priced in. Now we're down to maybe 1. Does that affect CEOs thinking about doing deals?
It really doesn't. What they care more about is the availability of debt capital rather than the cost. And I think we're at a period right now where the cost of debt capital, the risks are asymmetric. The risk that it goes up is lower than the risk that it stays where it is or drifts down. So that's kind of off the table today in terms of transaction activity. Economic uncertainty and political uncertainty now are not unimportant in having people think hard about whether they do transactions.
If you talk to private credit people, as I know you do all the time, they say, yes, we're lending a lot of money, but we're much more careful about it. We put a lot more restrictions and covenants and things like that on it. Is that true in your experience?
No. To be honest, I think credit, there's this thing called the credit cycle that we've heard about for many years. Credit, there are periods of time, like right now, where people feel some amount of pressure to put assets on the books, whether they're private credit or banking, and that tends to weaken a little bit the underwriting discipline, not thrown away, because I think we all learned from 2008 that discipline in credit is really, really important. But I recall once when I was at BlackRock, we were hired by Xerox to make a decision about what they should do with their insurance business. And one of the things we did is we visited 5 of the smarter people in the property and casualty business, one of whom was Warren Buffett. So we flew out to Omaha and we met with him. And he talked about the property and casualty business. He said, you know, I've bought every single one of my underwriters a golf club membership. And the only thing that I do is I tell them when they must use their golf club membership and when they can't. And his point was, there are some times when the underwriting cycle is really bad and I want you all to play golf. And there are times when it's really attractive and that's when I want you to not play golf and write lots of policies. And, you know, bankers and private credit don't have that same luxury. You know, discipline, not in major ways, but in minor ways, ebbs and flows. And pricing, the tightening of spreads. So we've had a period where longer term interest rates have risen. That has been largely offset by a tightening of spreads versus the Treasury market. So a double B borrower today can borrow more cheaply than they could a year ago, notwithstanding the fact that Treasury rates are up 80, 90 basis points.
I think there's a general sense that there's a pent-up demand for deals in private equity. The private equity doesn't want to sell a lot of assets right now because interest rates are higher, the prices have come down. Is that accurate? In fact, do you see a pent-up demand to sort of release some of these assets?
There is a pent-up demand on both sides in private equity. Most specifically and more immediate is the need to convert investments into returned cash for the limited partners. If you work at a private equity firm today, you've probably received a T-shirt as a gift from one of the large sovereign wealth funds or U.S. pension funds, and it says, DPI is the new IRR. And that means returned capital is now the dominant concern of limited partners.
You talked about cycles in M&A. Are there also trends? Because most recently, some of the deals we've seen have not been conglomerations, really bringing together bigger companies, but actually focus, spinning off. If you look at GE, you look at DuPont. Is that a trend right now in M&A? Are people more interested in focusing?
I would say, over 40, 50 years, you've seen a period of time when conglomerates were overvalued relative to the sum of their parts, and a period when they're undervalued. We're in one of those periods where in companies that are in multiple disconnected business lines, the value of the whole company is generally less than the value of its constituent parts. And so that is, if you're, and particularly when you can add to the fact that there are activists out there all the time looking at these companies and saying, do the right thing for your shareholders, disaggregate rather than aggregate. And, if you look historically over the last 20, 30 years, spin-offs, breakups have generally outperformed the market. They've outperformed the market because they've, sort of unleashed the entrepreneurial spirit in a smaller business that was really operating perhaps as, part of a big conglomerate, a little bit overlooked. And, one of the better investment approaches over the last couple decades is to buy these spin-offs or to buy these disaggregated businesses because they generally outperform.